Well, it's great to be back sharing another round of perspectives with all of you. And certainly we have started this year off with a lot of things going on all at once. Not much of a change from 2025, it seems. The Fed sits right in the center of it all, but this time around, it's not about policy rates. The market has become pretty comfortable with the idea that the Fed has little reason to change policy rates, at least for the first half of this year. It's really about the makeup of the Fed. And then, of course, intertwined in that, the independence of the Fed. We now have the announcement by President Trump that he has selected Kevin Warsh to be the next chairman of the Federal Reserve. However, those confirmation hearings can't begin until there is some decision made about the Department of Justice suit against Chair Powell for the monies spent on the renovations to the Eccles building. So this gets political very quickly at a time when we're trying to separate politics from the Fed. We do expect that Kevin Warsh's chairman position will get approved by the Senate in fairly short order. They do tend to take a couple of months. We have a few months to work with that. What we need is an open seat for Kevin Warsh to be a governor on the Fed, and we don't have that just yet. The thought was it would be Stephen Miron's seat, but he just left his job to actually spend more time focusing on the Fed. So it's going to get very interesting. The piece of the puzzle that everybody is waiting to see where it fits is what happens with Chair Powell. He is no longer going to be chair of the Federal Reserve in May of this year, but his governor position expires in January of 2028. He does have the option to stay. If he does, he will be the first governor since, ironically, Mr. Eccles, that stays on the Fed as a governor after his chairmanship position has ended. So we expect there still to be some drama around the Fed as we move through the first half of this year, getting a new chair in place, who actually remains as governors on the Fed itself, and we'll have to see where that all lands. The good news for our markets, though, in the fixed income space, we don't expect a lot of changes in interest rates, and we're seeing that affect our curves. So what we've had so far year to date is a little bit of a backup in terms of Treasury yields. We've seen the front end of the curve, kind of the shorter maturities of 2 years, stay pretty well anchored where they started the year, but we have seen longer maturities start to actually move up a little bit in terms of yield. We're actually welcoming that because it means that we have some opportunities to add even more attractive all-in yields in client portfolios. We came into this year, as you may recall, we have liked the structured parts of the market for quite a while, and we really felt like the best value was in agency mortgage-backed securities. Well, with President Trump's announcement that he is going to ask for $200 billion to be invested in agency mortgages by both Fannie and Freddie, that certainly changed the valuation picture, and so we made some adjustments to our strategy as a result. We still like agency mortgages fundamentally, but from a valuation perspective, they're a bit tight now. So we have continued to like other areas of the structured market, non-agency mortgages, esoteric asset-backed securities, and even traditional asset-backed securities to an extent now. Commercial mortgage-backed securities, another one where we have actually moved to a slight overweight because we think that there are some opportunities in certain parts of that market, not all of it. And then for duration purposes, we do like investment grade corporates, especially with the longer end of the Treasury curve, as I said, backing up. It's a nice place to buy all in yield, duration, and quality. And fundamentally, we're very comfortable with investing in investment grade credit right now. So part of the reason why we're comfortable with these calls is because as we look at the economy, we see it transitioning to be a pretty strong growth year for 2026. Our view on that hasn't changed. And interestingly, when Chair Powell took to the podium at the last Fed meeting, it sounds like the Fed has come around to that view as well, that we actually have an economy that is moving along pretty well and helps to keep the Fed on hold. The labor markets, well, we're not creating a lot of jobs, but we're really not losing a lot of jobs. If you look at the weekly claims data, it's not showing massive amounts of people rushing to get unemployment. We're getting layoff notices, but it's not transitioning into those people actually on the unemployment lines. So the labor markets have gotten to this balanced point with limited job creation, but not a lot of firing or quitting either. And so that's why we use the word balance. The challenge remains inflation. We continue to watch it closely. Chair Powell was rather sanguine about the prospects that inflation can become a much less of a factor as we look at the second half of this year. We don't see that as the case. We're more concerned that inflation remains in this stubborn, sticky range of, call it loosely 2.7 to 3%. It doesn't mean we need to raise rates go higher, but it does mean that we have a Fed that really is stuck in a position where they can't change policy rates. So that's really the wrap from here for now. Certainly as we move through the year and watch asset valuations change, we'll make the appropriate shifts in our strategies. But for now, we like where we're positioned and think there's great opportunity across many different sectors to build all-in yields into portfolios.